We have a distinguished lineup for you today. Firing questions at our insurance leaders is your moderator, the inimitable John Donnelly. John is a Managing Director and Head of Placement Asia Pacific at Marsh. With that, it's over to you, John.
Thanks, Eamon. Good afternoon, everybody. Welcome to the CEOs. Special thank you to you for taking the time to share your thoughts. Please remember to be kind to me. Brokers are a little fragile at the moment, as you would know. And thanks to you, Eamon. Eamon and I have known each other for about 35 years. I really appreciate his kind gesture of using a 20-year-old photo of me in the program. But as you can see, I haven't weathered the difficult market conditions too well. So we might update that photo for future years, Eamon. So it's nice to be back at RIMS, albeit it's on the screen. I'd rather be there in person. I really enjoy this session. I really enjoy the insights we get from the CEOs. I think we're going to miss the face-to-face interaction, but I think we can get a really enjoyable panel discussion going. It's a strange time for all of us, clients, underwriters, brokers. Remote working was a bit frightening to begin with, but now Zoom and meetings and presentations are a standard day for all of us, although we just had a few issues getting into this Zoom meeting, but we're working with those. Everybody's working with those now. And the market itself has been functioning effectively and client renewals are getting done. I wouldn't mind today, if we get time, that panel members share their thoughts on what permanent changes, if any, we might see in the industry when we come out the other end of this pandemic, about how we might conduct business together. Be interested to get your thoughts. So for the last couple of years at this conference, I've been preaching a fair bit of gloom and doom in the local and the global market. And broadly speaking, and unfortunately, it's turned out to be true. Whilst I expect the pain to continue for some time yet, and perhaps in certain classes will get more intense, I do see some green shoots. I see stability in the overall market capacity, albeit new capacity seems to be attaching to more opportunistic plays rather than the traditional markets. And I was heartened, and I'm sure clients were, by Juan Louis' comments this morning, that he's expecting property rates to begin to flatten. Jared, you might be able to put a time frame for that on that for us a little later in the discussion. So to our first slide, and I can see that's not working. Terrific. Jess, are you able to move those? Okay. The Q2 Marsh Global Insurance Market Index was published last month, and it shows prices rising across the world for the 11th consecutive quarter. In our region, it's 16 consecutive quarters. That's 4 years of rising prices. Never in my 40 plus years of broking have we had 4 years of rising prices. Sure, it hasn't been all classes, but clients who've had to endure increased insurance costs. And Juan Louis, again, he said this morning that the industry has only made an underwriting profit for 3 consecutive years once in the last 40 years. Well, so it seems like the buyers have topped that with 4 years of increases. So you can see a gradual increase in most regions. The US up quite a bit quarter on quarter, this quarter to the quarter last year. But the UK has been the standout increase year over year on these results. They've caught us in the Pacific, and largely a lot of that contribution from there is similar issues that we've faced in D&O, and the D&O market is a problem all over the world. I can't quite see the Pacific numbers on the side there, but the market average increase across all classes in the Pacific is 31%. The UK has hit that number. And even Asia, which I'm sure Craig, with his experience across Asia Pacific, can talk to us about, that the Asian market moved quite significantly. It's actually 50% quarter on quarter, the increases there. So we're seeing kind of real activity all over the world. We talked about this a couple of years ago. It was only a matter of time before the rest of the world started to catch Australia. Next slide, Jess. This is kind of breaking down. This is our region, the Pacific, breaking down property, casualty and the financial lines. In the property space, we're continuing to see movement. I think when Q3 numbers come out, they'll be a little higher than the 28 that we've got now. But the real mover we expect in Q3 is in casualty. Our September renewals are really showing some significant increases in price. And further, we're seeing a reduction in capacity where major underwriters are downsizing their lines. And of course, in the financial lines, it's continued to go up. 48% is an average across multiple classes. It's across D&O, but it's the major move in D&O is obviously listed companies. It's financial institutions and it's professional indemnity. So it averages out at 48%, but in some areas, particularly the listed D&O market, the spike is way above that number. The class, as I said, casualty is really starting to go. That's happening across the world. The winding back of line sizes is most affecting global programs. It's affecting bushfire liability here and some other industries. But the global programs with US exposures are being most affected. We're seeing, and there's an expectation that there will be a pretty significant increase in reinsurance costs on excess casualty, particularly in the US when we get to the 1/1 renewals. For property, I just got a feeling that we've been through the worst. And as I said earlier, I was a little heartened by what Juan Louis had to say this morning. But we're nowhere near through the worst of it for financial lines and for casualty. Jess, next slide, please. So this slide, I've been using this for a couple of years, and I think it best illustrates the reason that the market has moved so significantly. So just to reiterate, the combined ratio, it's the true measure of an insurer's underwriting profitability. It's the claims cost plus their expenses as a percentage of premium charged. So insurers are looking for low numbers here. 2017 and 2018 were horrible. 2019 got an award for most improved. Then the first half of 2020 has been diabolical, really. But a lot of that, on closer analysis, I think actually, if you look at the first half of 2020, it could be the first step in the positive news, even though the numbers are way up. That's because somewhere between 8% and 15% of the first half loss ratio results come from COVID, and they come from the riots in the US. So with the exception of Swiss Re and Allianz Global and Corporate, who are both going through major restructuring of their portfolios, if you take those COVID and riot losses out, the results were actually improving. The rate increases were improving the results of the market. So absent the COVID losses and the riot losses, the profitability was returning to acceptable levels. 1 year wasn't going to make the major difference, but it was certainly heading in the right direction. And clearly, those, particularly the COVID events, come from nowhere to make a major impact. So it demonstrates to me that the last couple of years and the last few years of re-underwriting and price increases were working. It's just an unfortunate move. And I suspect, it's going to take, as I said, a couple of years of underwriting profitability before there's any competition returns to the market. We always say at this time of the year that you do get a little nervous because we are just in the midst of the Northern Hemisphere hurricane season. And if every year we talk about it, if there are major wind losses in North America, all bets are off on results. And I think if we did have a bad season, the market would be in complete chaos by the end of the year. So just moving to the areas that that are major focus here for clients and the underwriters in our market, in our region, the areas that they're focusing on. So any account that's got major claims and a deteriorating loss ratio, the renewal pricing is being properly whacked by underwriters, and they're very difficult to get away. Cat exposed risks, catastrophe risks. I don't know an underwriter anywhere in the world who's increasing their appetite for catastrophe business. Capacity continues to shrink, and reinsurance rates are still hardening in that area. Large limit property business. There are several clients who are being forced to buy less limit, either because the historical limits aren't available in the market, or the cost of the last $1 billion in capacity is prohibitive and they're choosing not to buy. An area that's snuck into the market, probably understandably, in the middle of this year, and we're seeing more of it as the year progresses, and it will no doubt last well into next year, is the review of policy wordings. Policy wordings are being narrowed significantly. Sub-limits are being reduced. We had one renewal at June where the underwriters made 135 changes to the expiring policy wording. And we're going to see a lot more of those types of reviews over the next 6 months. I certainly hope it's not 135 changes, but we are definitely seeing much greater emphasis on historical coverage. And the last area is casualty, which I've already spoken about. It's going to become an increasing issue. It'll be really interesting to see what happens at the 1/1 treaty renewal season. Capacity and price is under real pressure in that area. So just touching on a few strategies, what should clients and brokers be doing in this market? We always talk about starting the process early, have a proper engagement plan, be very thorough in your engagement plan, talk to your senior management, talk to the C-suite. We mentioned that in some detail last year. Involve them early, get them prepared for what could happen. Make a review of what your claims, what your risk, what you've done to improve your risk, and articulate all those improvements to the market. And, the planning needs to have key milestones to it, and it's pretty difficult at the moment to impose those milestones on markets, on underwriters, but you've got to stay on top of them to get the result that we're looking for. We do need time in the market. So it is, it's challenging out there at the moment, but I said earlier, things are getting done, but planning is a key to getting everything done. Jess. This slide, just back one, this slide here, I'm just going to move on to, what I can see as the near-term future of the market. This slide, or slight variations and derivations of it, have been used by brokers for years to try and explain the insurance market cycle to clients. I'm going to concentrate in the area of the 4 hours, which is 10 o'clock till 2 o'clock. Which is about where we are now at 10 o'clock, and 2 o'clock is where everybody, all the buyers would like to see it get to. So we're probably somewhere, we're closer to 10 than 11, but we may be on the way to 11. It is definitely a seller's market at the moment, and to some extent, an opportunistic seller's market. But as I suggested with the loss ratio slide, absent COVID, profits are improving. And I know the panel members are saying losses are still losses and nobody priced for them. But assuming we get a vaccine, they are going to go away. The fact is that capital is flowing. It's not pouring into the market. In Q1 this year, reinsurance capital reduced globally by about 6%. And at the end of Q2, that capital had returned and we're back to 2019 levels. Now, I must admit that the new capital is being a bit choosy for my liking on where it's wanting to play. Nevertheless, it is providing much needed stability to the market. Historically, when we've had a hard market, there's a series of new insurers and reinsurers form, mostly in Bermuda, which ultimately results in competition returning to the market. This time, the new capital seems to be avoiding startups. It's going to what the PE firms are calling scale-ups and buy-ins. The scale-ups are companies like Convex, the company started by former Lloyd's Identity Stephen Catlin about 18 months ago, and Fidelis, a Bermudan company that's got a fair bit of Middle Eastern capital behind it. That's been around for a couple of years. The new capital seems to be attracted to these types of firms because they have no legacy claims and they've got an established go-to-market strategy and more particularly, they commenced underwriting when prices were high, so the prospects of a return is greater. A startup struggles with a speed to market problem. By the time it establishes, it will have missed a great deal of the pricing opportunity that the market has to offer. The buy-ins are the other home for new capital. These are typically smaller, underperforming companies who struggle to get traction in the hard market because of legacy issues and capital issues. It's been rumoured that some well-known retired market executives are trying to buy into and up these companies and relaunch them with new capital. Retired CEOs from Arch, Excel and Argo amongst the people rumoured to be behind such deals. And they're obviously seeking to take advantage of market conditions, use their names and establish businesses. And these established businesses already have a go-to-market platform. So there is positive news in the market for clients. We are moving towards 12 o'clock in the cycle. And if we can get a few years where the bell tolls at 11 o'clock with stronger profits, we might get to 1 or 2 o'clock a bit quicker in the cycle than many expect. I know my colleagues from the underwriting community will disagree with me or perhaps paint a more gloomier picture, but I would say that I don't feel as negative now as I did at the beginning of the year. Sure, prices are going to continue to go up for some time yet, and buyers are struggling with the global economic conditions, but the capital providers are showing the confidence to invest in our industry. Capital is the most critical factor in the market, and we've still got enough support enough capital to support the buyers of insurance. Supply still exceeds demand, but it is very much more cautious and a disciplined underwriting approach. So that's it from me for the time being. I know you want to hear from the CEO panel. I'm taking a very big risk here personally. I'm going to ask Craig to go first. I don't know why I'm doing that. It's not because he's the oldest. It's not because he's the longest, I'm the oldest, he will tell you. It's not because he's the longest serving CEO that we have. It's because he's the most argumentative. He'll probably get us off to a flying start and give us all something to think about. He'll knock me down, but he does need to remember I do have the last say. So Craig, what are your thoughts on the market?
Well, my first observation would be this is one of the very few times I've agreed with everything you've said, which is quite a disappointment. The only thing, looking at your clock, I don't think we're anywhere close to 11 o'clock. You know, just ticking off the things that you've mentioned, and in your own unique style last year, I think you gave everybody a strong warning as to what the future held over the next 12 months. And it's probably, I think you were right on line. I think the biggest drag insurance companies have got in terms of returning to profitability is investment yields. You know, a lot of the European carriers, of which AXA have bought us, you know, some of those environments are in negative yield territory. And so what I mean by the investment yields is the money, the premium that we sit on for future claims. You know, when I started with Excel, we were making 13, 14% annually. It's now down to 1.5%, 2%. That's one of the biggest challenges insurers have got. Looking at your index, it's not just a story of rate. It's a story, and you did mention that, it's a story of changing in terms and conditions. It's line sizing. You know, I think nearly every carrier's in a portfolio remediation process, which will obviously affect capacity. Casualty, I totally concur with you on the casualty increases coming through the Australian market. I think the number you've got for the Asian market is low. From what we're seeing, it's a lot higher than what the Marsh index is showing, and that's happened in a hurry. 12 months ago, that wasn't occurring. Agree, cat season. If the wind blows and the market takes a whack, that's going to have a significant impact on the 1/1 reinsurance renewals. And you can already see people starting to talk about how bad 1/1 might be. You know, my advice to buyers would be once again, aligned with what John said, is get in early, differentiate your story, be very transparent about what you're trying to achieve. Financial lines still continues to be a challenge globally as much as it is an Australian story. And I would agree the new capital, and there will be new capital. Every time this type of event in the market happens, there's new capital, and traditionally goes to Bermuda. I think it's been very opportunistic. It's probably going to chase specialty lines rather than large property and casualty lines. Convex is a really good example of that. So unfortunately, John, I've disappointed you. I haven't been able to push back. I think your clock's wrong. I think you might be on daylight saving time, but yeah, I would align with everything you're saying about the market at the moment. It's a really, really interesting market. If I was to look at the Australian market, Q2 was a interesting period of time. I think Q3 is going to be even more challenging in terms of rate increases and client engagements. It just seems to be rapidly unfolding.
What sort of pressures coming from head office, Craig? For portfolio reviews, and is it by line of business? Is pressure still as intense as it was last year?
Worse. It's a lot more intense about portfolio management and driving down the combined ratio to get to something that's acceptable to our new owners. So it's across every line.
Yeah. Thanks for that, Craig. We'll talk again later. Lynette, last year you talked about FM's return to basics, and looking at the numbers on the loss ratio side, that seems to have had a very positive effect on your results. FM's got a lot of advice for clients around managing risks in COVID, unoccupied risks, etc. I've read quite a deal of the information that you've got for clients. So if you wanted to share some of those insights, and I know from discussions you are personally also passionate about the summer risks, bushfire and storms that we have here. So what do you think clients should be thinking about with that season fast approaching?
Thanks, John. Well, first, thank you again for inviting me to participate on the CEO panel. I figure I must have done something right last year to be invited back again this year. So thank you. And just to let you know, on the slide that you were talking about combined ratio, I can fill in the number for FM Global at the first half was 113% combined ratio. I can even update that. Sure. And as of August 31st, it was 103.5. So, but to your point, we are trending in the right direction, so we are happy about that. But as you said, I would like to talk about something that's dear to my heart, which is risk management. Seems like a very appropriate topic for this group. But what I wanted to start with is idle facilities. And idle facilities are those sites that have been closed temporarily, possibly to reduce the spread of coronavirus, or maybe it is due to the downturn in the economy. But whatever the reason, these facilities should reopen when the economy rebounds. This pandemic has resulted in more of these type of idle facilities that I can remember, more than I can ever remember. Think about cinemas, sporting event venues, airports, schools, retail shops all come to mind. And I'm sure everyone on this call could probably think of at least one example. So I guess, what are the exposures? What we're seeing is idle facilities are by definition not occupied, and therefore they're prone to criminal activities such as vandalism, arson, theft, but also you could throw in water damage. So I guess one of the things that we're trying to reinforce with our clients is it's important to not lose focus on these types of facilities whilst you're navigating through these unprecedented times, because once the economy supports and gets back, you're going to want to get these facilities back into operation as quickly as possible so that you can meet your customers' demands. And let's face it, if you don't, somebody else is going to step in, and they will. So some of the things that we've been advising our clients is, firstly, make sure that your security and maintenance personnel are considered essential employees. Active security is the utmost importance. Perform regular daily rounds inside and out. Consider webcams and sensors, if you don't have them already, to detect any out of the ordinary motion, heat, or water flow. And I mean, if you think about it, perhaps you've had a small leak in your roof during this idle period. That could become a very huge leak because it just goes unnoticed for weeks. And of course, fire. We always want to talk about fire and the uncontrolled fire that can ultimately destroy your facility. So just make sure that your maintenance staff is checking your sprinkler valves on a weekly basis to ensure that they are locked open. It's not complicated. It's pretty basic, but trust me, the last thing you want is to explain why your sprinklers didn't put out a fire because there was no water due to the shut valve. The other thing would be water damage. We know it just doesn't happen to facilities that are located near a river. So it could happen from a major rainstorm or even a water main break. I just read a report today that Western and South Australia could receive about 2 months of rain in a few days based on the weather forecast. So an easy preventative measure for this type of exposure would just be to elevate your expensive equipment. And then finally, take the time that you have right now to perform overdue maintenance. For instance, repair that small roof leak that I talked about earlier. Repair it now, or perform your servicing of your expensive equipment now. The main thing is that when the economy rebounds, you don't want to lose a step. Otherwise, you're going to risk losing revenue, you're going to risk losing market share, and even reputational damage. And that is just something that is hard to get back. So that's one of the things that we've been really pushing on for idle facilities that are a current exposure right now. But the other aspect that we've been trying to enforce with our clients is, as we're all very focused on the pandemic, is also think about what your emergency response plans are. And as you said, bushfire is very important, but it could be wind, it could be flood. I would be afraid to ask everyone whose emergency response plans are sitting on a shelf collecting dust. And all I can say is now is the time to dust off your plans, review your plans, refresh them, and determine how you're going to best deploy your resources. Because this is easy. This is an easy, low cost or no cost measure that you can take. Many facilities, when you go back to work, are going to be working on a split staff basis. So make sure that the people on site have the knowledge and the authority to make decisions quickly. Acting quickly can have a huge impact on your damage. So again, be prepared, because these types of events are predictable. I mean, we see it over and over again. They're going to happen. And many times, if you just take corrective action quickly, it can be mitigated. So I guess from my standpoint, a pandemic is not going to stop other serious risks from occurring. So it's important, probably more important than ever, to just stay vigilant so your business remains resilient. And that's what I was going to present to you. So back to you, John.
Thanks, Lynette. Very, very good advice. Tim, continuing with the COVID theme, you've been developing an adapted risk control framework and disciplines for clients in kind of restricted world, the way you can do it. What are the clients most interested during this time with that adapted model? And if we have got time, I'd be interested in your thoughts, because we had a bit of a discussion about it the other day, you and I, about how we're going to work together in the future, and do you see major changes, and are we going to get back to this pre-COVID type, the world that we had before? Are we ever going to go back? Tim?
Yeah, thank you, John. And yeah, thanks, John. And good morning and afternoon, everyone. Great to be here as well. Probably following off the comments that Lynette made, I think it's really important that we continue to have that quality of underwriting submissions and differentiation in the current market. Coming into a COVID impacted environment, I think we were all scrambling it was new ground for all of us in working at how our workforces would work from home, how we would continue to be able to pay claims, how would we be able to continue maintaining relationships with brokers and customers. And I think as an industry, we've responded incredibly well. One area that we put a lot of thought to, though, was around risk engineering, and particularly when a lot of our clients and broker partners were looking at, in the current market around structure, retentions, overall insurance spend, really reinforcing the importance of risk engineering and managing those services. And one of the real challenges for us is we think we've got a great capability, as do yourselves, around getting our people out and about, meeting directly and face-to-face with customers, and trying to work through how we would continue to be able to see the real value of risk engineering services in this COVID-impacted environment. And we really saw an increasing level of demand for those services coming into that. One of the things that we did was we've got something called the Zurich Risk Advisor app, something you can go into the App Store and download as well. And off the back of that assumption being made that if engineers couldn't physically visit sites and the propositional value would be impacted, we really wanted to work closely with our risk engineering team using that app to really quickly adapt to the remote collaboration features that were in the app, just to continue delivering that service to our customers. And in that first couple of months, we had over 130 remote assessments with direct customer involvement. And we also had about 25 of those where we introduced Teams and the Zurich Risk app at the same time, just so we could have our customers or brokers walking around a physical site and engaging with our risk engineers and doing exactly the same as we would normally do with our various checklists and approach off the back of that. So that continued to work really well. That virtual live assessment has proven to work really well for our clients and has had some real benefits, I think, in terms of hopefully improving the quality of submissions, but really importantly, making sure we had the right dialogue as we came into a pretty challenging renewal environment. I might pause there before I go on to the second part or second question.
Yeah, I think, Tim, that clients have really struggled with that. As we have as brokers, trying to keep the underwriting information up to date, to get access to sites, to get access to key sites hasn't been easy. And I think anything that you've been able to develop that's going to make that simpler and more effective in these times is going to help in those renewal processes. We've spent a fair bit of time at Marsh talking about that with our team. So what about your thoughts on the future? Do you think there's going to be much change? Do you think we will ever get back to how it was, the way we did business before, or we changed forever?
I think it's a combination of both, John. I think if we look at our people's expectations, a lot of them have adapted to working remotely really effectively. The technology has done incredibly well to support that. I think the way in which our underwriting and distribution teams have worked through the last couple of renewal periods has been really outstanding. I think we've been able to demonstrate really strong contact with our broker partners and clients right through that. We've found different ways of making sure that we've been really efficient through that. One of the things I love about the industry, though, it's a people business, and we all really enjoy the face-to-face interaction. So one of the things that does concern me is that we're all leveraging 10, 20, 30 plus year relationships at the moment as we work through this impacted environment. And my personal view is that a Teams call has been very effective and probably better than a phone call, but there's no substitute for getting out and really understanding your brokers and your clients. And to do that, we've had all sorts of different shared experiences over the years. So I do hope we get back to some of that. And I don't think there's any real substitute for some of that face-to-face interaction. Internally, we're certainly seeing it, when you're dealing with large and complex projects, particularly if you're looking at transformational sort of projects, very difficult to continue managing those purely from a remote perspective. So, we're certainly encouraging our teams to get back into the office on those areas where it does really benefit that face-to-face collaboration, getting people into a room, onto a whiteboard, and and working through solutions. So I think that's really important. The other one for me is just around how we continue to build culture into the future. If you think back to your own career early on, you know, if you were starting a new role, it's very, very difficult trying to do that remotely. And I do feel for the people we've brought on in the last 6 months. We've really gone out of our way to best improve their experience of joining Zurich and making sure that they can develop their networks and an understanding of the business. But I still don't think there's any real substitute for a lot of that face-to-face interaction. And similarly, just sitting around a desk when you're new to an organisation and hearing the way discussions unfold, hearing the preparation for various client or broker meetings is incredibly important as well. So, you know, I think whilst we'll get some really important and valuable lessons around how we utilise technology, how we manage a more flexible workforce, expectations that are different from our people and our clients, I think ultimately we'll achieve an appropriate balance where we'll get back to more face-to-face interaction when this subsides. And again, it's certainly a part of the industry that I really enjoy, that face-to-face interaction, really understanding each other through different experiences, and those experiences you can't always do on a Teams or a Zoom call.
No, that's true. There will be some change. I mean, the thing that I've found is that underwriters are a lot braver over a Zoom call than they are face-to-face. But, you know, when we get back to more face-to-face. Jared, you're not last. The only reason you're last is because your boss got an hour's spot this morning, right? So, you know, he probably stole a lot of your thunder, and I definitely don't wish to rough you up too much. But, you know, last year you launched the Major Accounts Division. We talked about it on this panel. And since that time, you have, not too strong a words, I think, significantly shrunk your appetite in the financial lines world. And for Chubb, you know, that was their lead product here for a very long time. And it's obviously a key line of business to the major buyers. You know, is that having an impact, or is that a change in strategy or ambition for the Major Accounts Division at Chubb? I think, you know, if you could address, you know, that change. And I can't let you off. J-Lo did say this morning that he thought the property market was going to flatten. We just need a date. Your prediction for that, and then I'll just shoot it across to him and say whether that seems to be the appropriate time that he was thinking. So, Jared.
Well, thanks, John, for the first question. Yeah, look, I'll address it in a couple of parts. Financial lines. Yes, we've made a significant change in our underwriting appetite, in our pricing model for financial lines. We would have had the largest share of ASX top 250 sort of primary or first excess D&O and FI business. And we started seeing the trend in our portfolio pretty early, as early as 2018. And we did a lot of analysis. As you said, for many years, financial lines have been our lead product in the major account space. So it was a difficult decision to make. But when we did the analysis and looked at trends, we couldn't see what was going to change. We looked at the risk environment. We looked at the reporting requirements of boards, litigation funding with more capital supporting that coming to Australia, and then the ease of forming a class. And we couldn't see what was going to change in that. So we looked at our portfolio and felt that we had too much exposure in that space for the activity we saw that was coming, was coming to that segment of the market. I will say, every quarter since 2018, which is really when I stepped into this role, you look at prior period development, it continues to deteriorate as far back as 2013 for financial lines. So it's an issue. And one of the things I think we've talked about, this is a bigger issue for industry than the insurance market. We can all make decisions on capacity that we put down, the price at which we put it down, but this is a fundamental issue that industry's facing. And finally, I'm pleased to see Treasury's, making some commentary in regard to the reporting requirements of boards. So that's promising. some potential oversight of litigation funding, which again is promising. And potentially that will change the risk environment. But, you know, obviously COVID-19, this temporary slowdown in class action activity, how does that bounce back? We don't know yet. But until there's a fundamental change, it's hard to see how the level of activity, you know, the level of quantum of loss shifts in the Australian market. So yes, it was a significant pullback. You know, some commentary that were pulled out of the market. Interesting, I was looking at some statistics before I jumped on here of our portfolio, and you know, we still provide financial lines products to, it's almost 60% of the ASX top 250. So yes, we've made a significant shift in appetite, but we're still a major supplier to the major account, large and complex customer. So yeah, that's covering off, you know, but we've seen that globally. You know, you saw that, for those of you who are on the call this morning with Juan Luis, you saw the US history. We saw that, and we saw those exact same trends coming to this portfolio, and that's what drove our decision to make a significant shift in our appetite. Getting on to the second part of the question around major account. Major account, the division we established, that's not a strategy. It's not tactical for Chubb. That's who we are. That's been core of who Chubb is forever through both legacy companies. So really the establishment of that division was really to bring more of what we were good at to the customer. Ensure that we had a dedicated, focused team to delivering what customers in the segment need. Now, we established global client execs, and their role is to really assist our clients navigate through Chubb and make sure that if they've got a need that needs addressing, that's done, whether that's through Chubb Australia or anyone else in the group. So I was really listening to feedback we got through client advisory boards, not only here in Australia, but globally, on what clients were looking for in that space. And then ensuring that we had a team that was focused on trying to deliver to that. So no, that strategy, the ambition in that space hasn't changed. We're seeing the activity levels lift dramatically, particularly in our property and casualty product areas, where our appetite still remains strong in major account business. So yeah, whilst there's a pullback in one line, you know, we've you know, committed probably more capacity, more lines to more customers on casualty and property in the major account space than ever before.
To be fair to you, in the financial line space, you've got similar behaviour or reaction from your fellow CEOs on this panel. Of course, FM weren't involved, but you know, it's a troubled space. You know, we all know that. Much talked about troubled space, and as you said, you know, Treasury and regulatory involvement seems to be, you know, a major part of what the answer could be. Yeah. So, what's the date the rates are flattening? Have you got that? Is that tattooed in your diary somewhere?
It's not, John, but I think there's a couple of points. One that came out of Juan Luis's presentation this morning, and one out of your presentation today. You mentioned 4 years of rate increases in fire, and you showed that on your graph for Australia. But before, I can never remember 4 years of a hard market in property, John. So I don't think any of us have seen that. Furthermore, no. I've never seen at the end of a hard market where the Australia commercial insurance market still can't make money. We'll have another loss. We'll have another, and if you look at the APRA reporting results, another year of underwriting loss to the Australian property market. We had another $5 billion of sort of weather-related losses over the summer, and I think that's the big driver. It's a number of things have sort of you know, aligned to really change the risk environment that we're operating in. You know, how are we pricing weather-related loss? You know, we've you know, for so many years we've had vendor models for cat models for quake and wind and cyclone, but that's not what's driving a lot of this loss in this country. You know, it's southeast lows, it's bushfires, it's hail, it's flood out of the result of those storms. and the models are still emerging there. So I guess the question is, and I'm sure, you know, it's demonstrated with the profitability, the market's still coming to terms with what is the right or technical price for a lot of perils in Australia. So I still think there's an equilibrium to find there, and without trying to overreact. Is last year's summer, is that the new norm? You'd hope not. Is the last 5 years the new norm, or the last 10? So, you know, trying to get where the pricing is at. You know, I think that's one of the big challenges, particularly that we've seen in the Australian market. So, and different players are at different stages through the cycle as well. So putting a definitive date on that, you know, when the market changes is you know, impossible. But I do think, you know, do we get some stability in loss cost coming through? You know, the insurers take a more, you know, if we have a quiet summer, if Northern Hemisphere doesn't have a big cat year, do we start easing off on expectations of what the right cat price is? Does that provide some relief on pricing? But if we have a poor Northern Hemisphere cat season followed up by, you know, a pretty typical summer, it feels at the moment in Australia, it's going to continue to require a firm pricing. So I know I didn't give you the date, but there's some of the things we're battling with. You know, just answering what is the right price and then getting there.
Craig, he missed the opportunity, the headline. You want to take it? I couldn't see, were you nodding your head or shaking your head there?
I was just going to compliment Jared on how well he answered that question, and you're not going to get a date from me.
Well, perhaps I'll send a note to Juan Louis and see if he's got a date for us. But my own view is that the problematic accounts in the market will continue to remain problematic. Most underwriters are trying to avoid accounts with poor loss records, so they can, demonstrate to their senior management overseas that they're doing all they can to, redress the issues in their book. And, by saying that I've come off this account and the other account is one way of demonstrating that. I think we're suffering, picking up from your points, Jared, about what happened in the first 6 weeks of 2020 with bushfires and hailstorms, etc. It's put pressure on the models you guys are using to underwrite cat. And as I said in my presentation, I don't know an underwriter in the world who's trying to increase his exposure to cat. So they're going to remain problems in the market. But for the better quality accounts, with decent records, really good records, good market relationships, I do think there is a little bit more positivity than there has been, certainly in the last couple of years. Tim, what do you think about the market continue to go up in your view?
Yeah, look, I think very consistent with the earlier comments, John. I think we're going to be around that 11 p.m. area for a while, based on we need to get a period of strong profits, and reinforcing that 2020 is another challenging year, and we haven't hit that yet. And the numbers you put up really support that. There's still a number of major players that are operating well above 100% combined, and those that are sitting underneath it aren't delivering 94s or 95s and delivering really strong returns on capital at this stage. And I think until we see that, it's very difficult to see additional capital wanting to potentially come in and redeploy on those traditional P&C lines, which I think reinforces your comments around it's probably more going to be in the specialty classes where there's a little bit more opportunism. But in terms of your core P&C lines, we do need to see that consistent period of stability.
Yeah.
I'd also sort of reinforce that fin lines environment's particularly challenging. As you flagged, there's challenges happening at a global level, but locally, whilst there's been some good quality, in our view, short-term decisions around director responsibilities through the COVID environment. If you go back to the Australian Law Reform Commission report that came out in January or February last year, it didn't really flag a real intent or willingness to fundamentally change the legislation and change some of the really key challenges we've got around litigation funders, how easy it is to get a class action up in this country. And until I think we see some fundamental changes being committed to there, it's very, very difficult to look at profitability around those classes. Yeah. And similarly, cladding's a great example where the legislation or the court cases that have come through create a very different picture to when we actually underwrote the business a number of years ago.
Yeah. Lynette, FM, have prided themselves over many years on pricing stability, and we talked last year about some of the reasons why your loss ratio might have been more in line with what was happening in the rest of the market, and you're back to basics and so on. Have you been able to continue with the same support from the reinsurers? I know you're a big net writer, but you do have some reinsurance, particularly on the cat side. So you've been able to continue to get that support from the reinsurance market?
Yeah, actually our cat treaties renewed in June, July. So even though they were a bit over budget than what we had expected, it wasn't overwhelmingly over budget, and there was some restriction in some capacity, but nothing that we felt that was material that had any really impact on how we would proceed with our offering. It will be interesting to see what happens with the renewals, cat renewals for treaties in the Jan 1 period. As you state, hurricane season in the US is not by any stretch of the imagination over yet. So that can always come into play. And we have seen retraction and withdrawal of the communicable disease coverage with the reinsurers, which is in turn playing out in the cat treaties, which is in turn playing out into what offering insurers will be able to go forward with. To me, I would compare it very similar to terrorism, in the fact that after 9/11, the reinsurers pretty much took a we won't cover terrorism anymore. And I just see that's the direction that they're taking with communicable disease going forward.
So it seems to be, and it's hard to envisage that that market's going to open up again significantly in the short term. But interesting cases are all over the world, and something that's being talked about a lot this week with what happened in the UK. Anyway, why don't we move on to some of the questions? I think I can pass some of these questions off to you guys, and I'll just go in the order that I've got them on the screen here. They're not the order they came in. So first question comes from Anthony Chung. If most large corporates are already starting the renewal process early, providing quality submissions, paying attention to risk engineering, have a thorough market engagement plan, and then how is differentiation from if everybody is doing this? If I had first crack at it, I would say it'd be fantastic if most large corporates were ready to start the renewal process early and were ready to provide the information we need in the quality submissions. A significantly large percentage are, but there are plenty who aren't. It's not actually a matter of differentiating you from another account. It might be differentiating you from peers within an industry. But certainly if you are not early in the process and you haven't got this information, you are just going to be shuffled down the pile. And the later it gets into the renewal process, the worse the result that you're going to get from the market. And particularly if you've got a program that is supported quite heavily by facultative reinsurance, which is still a problem in the marketplace. Jared, maybe, with your major accounts division that we were talking about earlier, how important is submissions and how important is an early start to the process to you guys?
Yeah, very much so. I mentioned about cat, and cat pricing is driving so much of the variability in pricing now. So the quality of data that's available there through construction it still does remain inconsistent, even the large account end. So the quality and what's required from the underwriting community, understanding that more. You know, it's just simple things around age of construction, age of building, details about the construction, not just its concrete, it's sort of roof, getting into the further detail where that's available, all adds to the data quality of your submission. And if I think about it when I used to be in a role where it was involved in buying reinsurance. What all we were trying to do was attract more reinsurance capacity to our account, even if we didn't need it, particularly on supply and demand. That's what you're looking at here. You've got less supply, you've got less people putting capacity out. So how do you attract as much of the capacity that's available in the market to your risk? And, you know, you are the industry you are, so you're within that framework to start. So within that industry, how do you position yourself to attract as much capacity as you need to your account, pretty well at the expense of some others in that industry? Because that's how a lot of the market's looking at things now. How much do I want to deploy for an industry at a location or in a geographic area? So the better you position yourself, you know, a simple supply and demand economics, the more capacity you attract in, you know, you don't have to take the more opportunistic capacity that's always going to be more expensive.
Okay, thanks, Jared. Here's a question. This is perfect for you, Craig. Lakesh Thondavada. Working from home should have reduced significantly expense ratio due to travel and entertainment restrictions. How much of a positive impact work from home has had on the combined ratio shared for major insurers? So you would be one of the great travellers of all time, Craig. So the expense ratio will have reduced. So you got a comment on that? Is Craig?
He's on mute.
I think he asked to unmute. No, Craig's gone.
Happy to take it, John.
Yeah, sure, Tim.
Yeah, look, I think impact on expense ratios aren't as great as what most people might think. There certainly travel and entertainment and so on has come off pretty dramatically. But if you look at our fixed cost base around buildings that aren't being fully occupied and just the underlying cost of doing business, a lot of that actually hasn't changed dramatically through this period as well. So we're all again under pretty intense expense pressure. I think the real challenge will be as our clients' business, your business, our business goes into 2021, the expectation will be that the starting point is probably going to be more around our adjusted expenses in 2020. So, you know, I think it'll have a positive benefit to our combined ratios, but again, in terms of really addressing fixed cost, it hasn't had a major impact at this time.
Not material. Not material. Question from Katie Sexton. In this very hard, possibly even harsh market, it seems that the ability to accept terms offered now often trumps the relationship. What, if any, value do insurers place on long-term relationships? Do you, or in fact, can you discriminate accordingly, or is it just a numbers game with the innate value of relationships to be a topic for another day? Lynette, you know, long-term,
Sure.
you've got clients that go back 100 years plus, but you know, what's the churn in your book, and what's the relationship angle? How important is that to you?
It's always very important, and as you say, I think our average tenure is about 19 years with clients. So we do have a very long tenure. However, I will say that you know, all relationships are very key to us, but we are all faced with being profitable. So going back to the basics, like we talked about last year and this year, it's going to be a matter of also looking at it's a partnership, as in terms and conditions and pricing. So it's going to be a matter that we will want to come along together rather than us, you know, just going back, and we're looking more at a step change rather than just hitting them over the head with, we need to improve this program. But it's also going to be a matter of risk quality and risk improvement and bringing them on the journey on getting them to be what we would call a highly protected risk. And for those types of risk and those types of clients, we would be in for the long haul.
So sorry, John, it's Craig. For some reason I've jumped off, but I'm back on again. But I'm glad I dodged that question.
Yeah, you've hung up on me before, Craig, plenty of times.
Oh yeah.
Yeah.
John, if I could answer that just in a different way.
I think
when we
so.
look at our when we look at our major account space, our new business price adequacy against our model price is higher than our renewal price adequacy. So that just looks at the selection that we place on new business we bring into the portfolio and how we price that business. And, you know, like Lynette, you know, in the major account space, we look to have long-term relationships and build an understanding of the client's business and construct a product and service offering that meets their needs. That takes time.
Yeah.
Yeah, but I would just come over that as well. As carriers, long-term relationships are extremely important because renewing existing business is a hell of a lot cheaper than trying to get new business in. So it's really important that we can have those long-term relationships. So I think all of us on this call would have a very similar view to our book of business.
Okay.
I might add further as well. I mean, we've got a huge track record around our international program business or multinational business. It's an enormous global investment that takes decades to really build that capability. And we really do see the importance of a lot of those global relationships that do go back decades with our organisation. And whilst each part of the underwriting cycle presents its own challenges, the ability to work deeply with those client relationships, understand how their businesses are evolving is really important. And that go early message is great, not only from the underwriting information, but making sure that we're trying to run a culture of no surprises to each other, really understanding like those long-term partnerships, how are the businesses changing, what are the things that they're looking to put onto the table that are potential challenges or issues or opportunities for them, and similarly for us, having the opportunity for ongoing discussions rather than just a renewal-related discussion is really important, I think.
Great point, Tim. Great point. Here's a question from an anonymous attendee. If underwriters are electing to walk away from organisations that they have underwritten for decades for the purposes of showing improved underwriting discipline to senior management offshore, do these risks stay permanently off the underwriter's books, or is it linked in with the insurance market cycle? When do they get the decision-making pen back? Well, as an opening comment, I'd say that all underwriters retain the right to be fickle. Today's bad risk in a few years' time is something that when they're in growth phase, they might be interested in re-looking at. But a lot of it will be dependent on the characteristics of an individual risk and the reasons that they did walk away. If it's losses and the losses don't improve, clearly nobody's going to want to take it back. If it's got very big catastrophe exposures all over the world, it's hard to see in a short term that's going to become attractive. But unquestionably, underwriters go through different phases, and when they push the button for growth, some of that, some of their memories of past of the clients disappear, and they'll be interested in that business. Got any thoughts, Jared, Craig?
Yeah, I'm happy to just quickly on that. I'll take financial lines because that's what's impacted, and that's most the clients on this call more than any other product line in recent memory from Chubb. So we looked at that. It's more about the risk environment overall that we're looking at, and where we could and what our risk appetite was there. Until that changes, our view doesn't change. So it's not as though we would go back to those clients next year if the rate was up up even further and say, actually at that price we would quote. That's not the action why we took the action. particularly on a number of clients that we'd had for decades in some cases. So it was a very, very difficult decision for us to walk away from those clients. And it was about the risk environment. So if that changes, then our view would change. So that answers the majority of action that we took in regards to financial lines.
Yeah.
Yeah, I probably don't have much more to add other than what Jared said. I think, you know, there's, you know, insurance companies have got two people to serve. They've got their shareholders and they've got their clients. And at times those things clash. So I'm sorry, I apologise, Lynette, you don't have shareholders. You've got clients and clients on both sides of it. But yeah, I think it's a fine balance as to how we get through that with the major aim of, you know, without clients, we don't have a business.
Yeah.
So we need to maintain that.
You got any experience with this, Lynette? FM having walked away from clients and taken them back, but it probably improved risk engineering would be the only thing that would attract a client back to you after you'd walked.
Yes, you're right. And yes, we do answer to our clients, which are policyholders, and trust me, they can be very harsh on us, just as well as shareholders, and the fact that they would like to be only have the best clients in our mutual company. So, but yes, of course, we can walk away from a client if, again, we're on a journey with risk improvement. If we feel that that has stalled out or that there's just, it's not sustainable, then we could walk away. But in the interim, do they change their way? Do they change their approach? Do they start doing things proactively? Then yes, we would consider reconnecting with a client that has taken on that risk improvement and looks to improve their risk on their own. It's even better when they're not being forced to do it because reinsurance is driving that. It's, for us, it's the ultimate when they do it on their own because it's the right thing to do.
Thank you. The proactive early engagement by clients is not proving helpful in some cases due to some underwriters choosing not to engage until the month of renewal. How do the brokers, senior contacts at carriers assist clients with this roadblock? Frustration, a lot of times it's a frustration. I think, you know, there are a couple of factors at play here. The whole renewal process takes longer now than it did historically. The extent of modelling, the extent of referrals within underwriters to more senior people, including overseas referrals for the multinationals, all of that takes time. And the other, you know, real roadblock, thing that slows the renewal process down is where facultative reinsurance is involved. Getting answers and getting the correct answers out of the facultative reinsurance market is a real issue at the moment, and that is causing a delay in many of the renewals, but it's also a reason as to why you've got to get in early for the referrals, for the modelling and for the facultative reinsurance. Jared, you've got thoughts?
It's spot on, John. It's probably, that's the single, I think the facultative reinsurance where there's accounts where people are, you know, where insurers are looking to lay off some of the risk. That's the single biggest hindrance to getting terms out early that we're finding. When we're putting, it's 100% of our net capacity, net and treaty capacity, it's down where we always have those terms out on time in a reasonable time. When there's facultative reinsurance, that's when we struggle to meet expectations of clients.
Yeah. Tim, anything from you?
Yeah. No, I think very consistent there on the fact side, but you know, certainly we've been really encouraging early conversations and discussions, and again, for the long-term relationships, it should be an ongoing discussion. You know, the other thing that you sort of come back to is the ongoing engagement, just to see where risk appetite's changing, both within the underwriter and the customer. And as we spoke about last year, this forum, we've spent a lot of time around our captive and structured risk solutions area, and you know, that's another area that you know, it doesn't make sense to be doing that on an opportunistic basis at any one point in the cycle, but having those ongoing discussions with our relationships around how we might be able to help manage risk appetites right across the cycle is important as well. And you know, those ongoing discussions have been really important for us.
Yeah. Lynette, do FM have a timetable they look to be following for getting renewal terms to clients?
Ideally, we would love to start 6 months out, but we all know that that's probably unrealistic. But yeah, we were probably more in the 90-day range. If we know it's going to be a difficult renewal, then we would want to start out 6 months early. And that's one of the things that we have to work towards so that we all know what the expectations are when we get to that point. But 90 days is typically how much time we feel like we can do a good job with that.
Okay, thanks. Here's a question from former panel member Willem van Wyk. Would appreciate if the panel can comment on the contracting broker market through recent mergers, I guess proposed mergers too. Does it create risk for insurers, and will there still be healthy competition for clients? Want first shot, Craig?
Oh, thanks, John. Yeah, you know, I think we work in an industry where we have, you know, certainly the people across this table, we've got a massive reliance on 2 or 3 forms of distribution, and you know, any business model that's not terribly healthy. Will it reduce competition? I'm not sure, and obviously the Aon Willis transactions still yet to go through, but yeah, you and I go back years where you had lots of different forms of distribution. It's now contracted to, well, probably by the time we're sitting around the table next year, to for the large complex accounts, it's going to be dominated by 2 forms of distribution. If I'm a client, I still think I'll be able to get competition. What it means to the carrier business model, that's probably a different discussion, which I probably would not like to discuss in this forum, but I think it certainly will change the dynamic for sure.
Yeah. Jared?
I agree with Craig. No, I don't know.
That's his line.
I think if you look at some of the capabilities that are getting brought together, you can see that there'll be advantages for clients. I won't go into all the details of the 2 organisations, but you can see the advantages happening and efficiencies. It's the competition piece. You know, you're going from the 4 major brokers in major account space. You know, I still think the competition between the big 2 is probably going to get even more fierce. And you could probably expect that there'll be some emerging brokers that will look to step into that space now. So does that bring out competition? Yeah, for underwriters, it's a challenge. We've seen it before though. You know, where we've seen massive consolidation in the broking industry, and yeah, it's probably like Craig. I won't comment on that here, but you know, I do think if there isn't enough competition emerges, and that's the free market.
Yeah. Tim, anything from you?
I think those very consistent with those comments. I think if you go back to your underwriting cycle clock, you get to 1 a.m. on the underwriting side with new capacity emerging. You probably look at the same thing on the distribution or broking side, don't you? But if competition disappears, and it's amazing how many new players will potentially stand up to take a share of part of it at least. Yeah.
Yeah. Here's a D&O underwriting question. I'm not qualified to answer. brokers have commented that some Australian D&O underwriters are electing not to follow London markets, which are scarce if they are in the lower excess layers of a D&O program. This is incredibly prohibitive in an already difficult market for clients. Any views on this dislocation between Australia and London? I do know that the major Australian insurers of D&O have historically wanted an Australian-based leader of the program. Jared, your former large book, what was this an issue in the D&O space?
Look, it's all about how the claims will be handled, and we certainly haven't got something imposed there, but it's certainly around the ability of, if they're picking up the lead, it doesn't matter whether it's London-based or Australian-based. If you don't have confidence in who the lead carrier is and their claims capability, you'd have concerns putting your capacity down behind that.
Yeah. Craig, have you been involved in these kind of discussions?
Yes, and I don't see any dislocation between Australian leads or London leads or other market leads. Jared's spot on. It's all about the ability to manage the account properly if you're sitting behind it. We've got no mandate around not following, going back to the question, was it Lloyd's or London or both? But we've got no mandate around that.
Okay. There's a question from John Holmes. How are the panel harnessing data and new technology to underwrite risk? What will this mean to clients in terms of providing smoothing of cost fluctuation, longevity of support? Lynette, you're using a lot of technology to help you underwrite risk. You want to comment on that?
Sure. We, as you know, as we go out to a site visit, we have a bunch of data points that we're gathering, and we're now using that for various purposes, whether that be for boiler machinery exposure. We're also modeling bushfire. There's so many different elements that we can use that data for. So I think it just helps us refine how we underwrite risk going forward.
Yeah. Well, how important is it in your world, Jared, in respect of property risk in particular? When you're managing that international property portfolio, what's developing there?
Yeah, I think the answer to the first question, as an industry, we're not using it effectively enough at the moment, and the level of investment, and I'm sure across everyone on the panel, is huge in that space, because we can see what it does mean for us, and does mean for the frictional cost of renewing every year. The better quality that we can supplement, that doesn't need to be supplied every year from the insureds, that gives us the data to make a decision on is significant. But yeah, look, it's variable around the world, between just getting basic fundamental data that we had here 20 years ago, to some quite sophisticated regions. So there's a long way to go. It's a huge focus, and I'm sure, as I said, everyone's spending significant money to do this better, but I think that'll change the way it'll deliver more consistent pricing from a technical pricing aspect. How much does market conditions override that technical pricing? And that's probably the question. And then, will we be better able to use data to pick trends in loss cost, irrespective of the product line, ahead rather than backwards? And not having a go at actuaries, but actuaries have been fantastic in past of telling us what's happened. How do they tell us the trend for the future, and how do we price that? And that's the big shift in pricing, that as an industry, that everyone's working towards.
It's that point you make about the market. I say that to our team all the time. They say, well, how can the technical price be this? I said, well, a key influencing factor in the ultimate price is market. We do operate in a market, and the price in a market fluctuates up and down, and how competitive that market environment is. Craig, as with the AXA Excel moving into AXA, has that brought you any more modelling capabilities or data capabilities than you had previously?
Yeah, because it's a bigger data set. So, you know, the more you get, the better you get at it. And obviously AXA is a huge operation globally, and yeah, so it's certainly added to our capability in terms of understanding what we're doing and where we're going moving forward. More importantly, not what we're doing going backwards. So,
yeah, I think, you know, we've only got a couple of minutes left, but this is probably a really important question that I'll get each of you to make a comment on in as regards to your employees. So if possible, could you please share any insights into managing employee mental health and well-being in these difficult circumstances? Tim, why don't you kick off? I think it's an important topic here.
Yeah, I think it's a topic that is top of mind to all of us, John. I think, you know, if we look at the COVID environment and the comments before with, you know, one of the downsides of managing a workforce that isn't coming into the office, and if you look at the situation in Melbourne, particularly exacerbating that further as well, it is such an important time for all of us to be checking in with our teams to really make sure that, you know, important role of all of our leadership teams is to be keeping a really close watch on all of our people, really understanding the challenges that they're going through. As a group, I think we're doing it pretty well in terms of the, you know, expectations that have been set out of Zurich around how we manage this, and we've actually invested into a new business called Wellcare, which you know, a lot of that aligns with what we're doing on the life and investment side of the business, where, you know, really making sure that we're aligning that that well-being part of our proposition with our customers as well. So something that is top of mind, including the investments we're making around data and analytics in that space too.
Yeah, thanks, Tim. Lynette, when we were talking the other day, you said that nowhere in the world will you be back in the office before next year, and that could move out to the middle of the year. So there's obviously a great deal of thought going into that in your organisation.
Oh, certainly. Yeah, for us, I mean, I feel like we're in a pretty good position when you consider what's going on in the US right now. And when I said to the middle of next year, that's more geared towards what our US offices would be looking at. We are still very hopeful that we could be back in the office by the first of the year. But it is difficult to try to always make sure that everyone's mental health is in a good place. And we're just trying to reinforce with all the managers and even individuals to continue to reach out, because I think this is one of the biggest things about this pandemic is it can be so isolating and it can just be lonely. I mean, I feel like there are a lot of people that live alone, especially if you're in Melbourne and you just physically can't really get out and socialize. And I had always thought when we were going to go back that we would still have a lot of people that would choose to work remotely a couple of days. I think that will be the future, but I do see that the people that will want to come back to the office are those that are seeking that social interaction. So we're just trying to support that any way that we can.
Yeah, thanks. Craig and Jared, we've got sort of 1 minute left. Just some thoughts from you, Craig, first.
I totally concur with everything that's been said. It's paramount for us at the moment. Making sure, like I say this to my management group all the time, I forever worry about the one person that's sitting in the corner saying nothing and struggling. And, you know, we're really pushing to make sure we don't have that individual.
Jared?
It's the single biggest increased focus area we've had through this period, is ensuring the mental well-being of our team.
Yeah. Okay, thanks everybody. A great session, really enjoyed it. I think having that half an hour of Q&A and actually having a smaller group worked really well. Got to interact a little more than we have in the past. We certainly had more time for Q&A. So again, as I said at the outset, thank you, Tim. Thank you, Lynette. Thank you, Craig. Thank you, Jared. Fantastic of you to give your time. And be so open with the audience, and you know, just a great session. So look forward to seeing you soon.